You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose and the Loose. I hope you're doing well on this Friday. Retirement Friday. Looking at your retirement portfolio during summertime. Preparing for a potential crash. Why am I saying that? Well, just because fall is known to have some pretty bad months, right? October crash of 87, the financial crisis of 2008. Started during summertime, but the big peak was like definitely September, October, November. And if you look at stats overall, it's not necessarily a bad period, but this year, there's a lot of things that could go wrong, and this is what I want to talk about and see how we can protect our portfolio. If it happens, but also if it happens at any other time, because right now we're still trading close to the all-time high. It's still the right time to make moves in your portfolio. If you have hesitated, well, now is the time, because maybe tomorrow is going to be too late, right? So here's what could happen in this fall, like starting September and going forward. So, of course, more tariffs, debates, news, noise, I would say. But slowly but surely, we have like those like tariffs are being increased, like no matter what's happening, right? So it's not probably not to be the 50% that was promised like back in April, but still 10% here, 10% there, sometimes 20. I don't know. It moves all the time, but this impact could create a lot of like uncertainties from the market, and probably the market will like it, right? The other thing is, now that we have a few months with some base tariffs that were applied, well, we may get into companies reporting worse earnings, like bad earnings, like disappointing. And there's nothing worse than a business reporting their earnings and say, yeah, we have to review our guidance. So not only the numbers that you see right now are bad, they're worse than expected, but then we review our earnings like for the next like 6 to 12 months. And like when you downgrade your guidance, that is a big opener for a double-digit drop on the stock market. We have seen that so many times. People start panicking, but it's just not normal, right? So financial analysts, they price a stock based on their assumptions, and then at one point, somebody else is telling them, well, those assumptions are not good, and you have to review them like downwards. So of course, stock price will be following the reviewed guidance. The other thing that could happen as well is bad economic data. So far so good, but I wonder if we will not see the recession coming up, especially in Canada, with all that like noise happening, the tariffs and the consumers that are getting stuck with a lot of things to pay. So I don't know. We'll see how it goes, but those three things could happen. And then you need to protect your portfolio, especially at retirement, because you cannot add more capital moving forward. You're actually on the other side of that strategy where now you withdraw income and potentially capital as well. So that is not necessarily something you want, right? And it could be like, it could bring some level of anxiety. So we're going to take a look at what could you do. So first things first, you must have a strategy. So having an investment strategy is not just like, I invest in dividend growth stocks. That's the beginning of a strategy, but that's not enough. Your strategy should cover good moments and bad moments too. It should be like the same strategy that will help you go through good and bad markets. You should have considered having a protection system already, of course, right? So that protection system could be in different way. We're gonna talk about it in a moment. But you need to have that protection before things go worse. Because if you have noticed, whenever, for example, a good protection, we're gonna talk a little bit more about that later on today. But a good thing would be having like gold, investment in gold, right? But gold is gonna rise as soon as the market is like concerned about something. And if you look at what happened at the beginning of 2025, we saw gold rising on the fear of having those tariff announcements and then all the market noise, and then we just saw gold price going up naturally. So if you wait until it crashes, it's a bit too late to buy in gold because you're buying at a high price, which doesn't make much sense, right? Regardless of what's happening this fall, it should not be different. Like, your investment strategy should go through all of that. And remember, one other thing is, you do have a plan. You do have a financial plan, right? So your retirement plan has been made to include moment like this. If there's a crash, there's absolutely no problem, as long as you have a plan. Because I mean, we discussed that last week on the Retirement Friday. The expected return that you're using is probably conservative, so it's normal at one point you're going to show like minus 10, 15, 20, maybe 25% on a year. I know it sucks, but it's not the end of the world because it's already planned in, so you should not worry about that. So now, how can you protect your portfolio? As I just mentioned, having gold or fixed income in your portfolio is a good way to prevent some volatility. Gold has this tendency to perform well when the market crashes. Bonds will likely be relatively stable. So those are two things that you can do if you're worried about market volatility. In my opinion, I don't need this because I really love market volatility. I really don't mind. And when my portfolio is down 25%, I feel exactly the same way than when my portfolio is up 25%. I don't mind about that because I focus on the long term. One thing that I will change at retirement is, and I've said that a million times already, but having that cash reserve. The cash reserve will preserve my buying power. So if the market is down this year and I'm retired, I don't care because I have income coming from my portfolio, and I will have the cash reserve to supplement, to bridge the gap between what my portfolio generates and what I need at retirement for that year. And the cash reserve will be good for the next 3 years, so we can go into a crisis. It's all good. One other thing that you can do as well is to review your stocks by metrics, not by stories. So now is not the time for taking guesses, for hoping. Definitely not. I mean, every year that we are trading close to an all-time high, we're getting close to the chance of having a solid bear market. I mean, it's just pure logic, right? Maybe it's going to happen, maybe it's not going to happen, but one thing is for sure is right now, like, the tide is high, so you want to make sure that you get rid of like all those potential risky stocks or any other assets before the tides go down and then we realize that we were swimming naked, right? That's not something you want to do. So right now is the perfect time. Review the numbers. Like, I tend to forget about the stories in my investment thesis when I review just the numbers in those situations, because I want to take a rational decision, not an emotional one. So even if I like the stock, even if I'm positive in terms of stock returns, this is not what I'm going to look at. I'm going to look at the dividend triangle. So the revenue trend, the earnings per share trend, the dividend trend. Dig for more investigation and when something doesn't look that great, but now it's not the time to take guesses. One other thing that you should be careful of is stocks or other assets in your portfolio that are priced for perfection, meaning that they had an amazing ride, but right now they seems to be a bit overvalued in the sense that they are trading over their average PE ratio, for example, or showing a dividend yield that is under their average yield. So now the market has high expectations, and of course, if, as I said earlier today, when the management revised their guidance, it's not going to look good. So you have to be careful about that part. So review companies that are priced for perfection. Maybe it's the time to trim a little bit on those to cash some profit, and just make sure that you're not overexposed to some of those great companies. Be careful also about trends and hype. They don't tend to do well when the market goes wrong, right? So when there's a bear market, one of the things that will actually participate in creating that bubble first would be trendy stocks, hype stocks. So just want to make sure that you don't have too much of those. And it's normal to have some. I mean, right now, cryptocurrencies has had an amazing year. So a lot of companies around that will do well. Well, then maybe it's time to trim again. Once again, it's just like not taking additional risk to make sure that you protect your portfolio. But long story short, if you have done your homeworks already and you have a strategy and a plan, you should not be doing anything else, because unfortunately, this is not the last time. It's not the last time that you're going to go through a bear market. And then again, I'm talking about the potential thing. Maybe it's not going to happen. So that's why I'm not too in a hurry to make modification to my portfolio, even though I'm bracing for impact. I just a lot of things do not look that great, but that's not a reason for me to go cash. That's never a reason, because first, I could be dead wrong, and that is super important. And second is, as long as I invested in high quality companies, I don't have to worry about the next crash. Regardless if it happens or not, the strategy will take care of it. And my plan has already factored that in. So that's not a problem either. You should feel the same way about your plan. If you do not, I suggest that you subscribe to our free newsletter about retirement at retirementloop.ca. So it's retirementloop, LOOP.ca. All right, Moose, that's enough for today. We're going to talk again on Monday. And until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.